Hi guys, today we're going to do something different. We're not going to look at any charts. Instead, we're going to focus on our trading system and why it is that it's important that we have trust in our trading system. This becomes particularly relevant in times where trading is frustrating. You're in a drawdown, your equity curve isn't making new highs, you're missing, trades are coming within a few points or pips of hitting your targets but not quite getting there. You're getting stopped out, trades are running in the opposite direction. That kind of market environment makes it can be very frustrating for many people, and what happens is there's a tendency to start breaking rules in terms of trading. Now, to avoid that, what is important is that we reflect back on the reasons for why we have trust and should continue to have trust in our trading system. So it's going to be a bit Excel based in terms of what we're going to talk about today, but really I'm going to cover these particular areas. I'm going to talk about the importance of eliminating subjectivity, eliminating uncertainty, decoupling results and expectancy, and then executing with confidence. Let's talk quickly about eliminating subjectivity. Now, with subjectivity, there's a great degree of uncertainty that can potentially creep into your trading system. I'm a very rule-based, I like following a very rule-based set of trading systems. I know other people are more flexible in terms of their rule set, which is fine. But the important thing is that one must, as far as possible, eliminate subjectivity to avoid that high degree of frustration creeping in when things don't go our way. So one of the ways we can do that is by articulating our rule set. So if we look at rules, and this is just a really high level summary of a particular intraday trading system that we do use here at Underdog. Guys, please don't take what's written on the screen as a comprehensive set of rules and try and apply that in practice. It's not going to work. But what I wanted to highlight from this is really you need to set out exactly how you're going to be approaching your trading. So what is the time frame? 15 minutes that we're going to be approaching. What are the conditions that need to be in place for us to establish a setup? So you set those out. You must have a particular pattern if you structure trading. If you're using indicators, the stochastic must be in a particular position. If you're using Fibonacci, your price must be within a particular Fibonacci zone, etc., etc. So this is really just where you brainstorm. If you're setting up a new system, this is where you brainstorm and set out all your potential rules for trading the system, and also try and set out all potential scenarios, things that could happen. What happens if you get a setup, an opposing setup? So setup while you're in a trade, you get a setup for a new trade in the opposite direction. What happens if you're in a trade, in a long trade, and you get a setup for a new long trade? How do you roll your stops? Do you roll your stops? What is the minimum reward to risk you need in a particular setup in order to make it valid? As far as possible, and as you develop your system, you'll find more and more nuances that you can fit into your rule set. But as far as possible, what you want to be doing is identifying if the market does X, or if a condition arises, a particular condition arises, then what is your response? What you don't want to do is you don't want to be in a trade in a live market environment where you identify or a particular condition arises and you haven't had a comprehensively tested response to that particular condition. So in this space, this rule set, you can be dynamic in terms of your rule set. You can refine it over time. That's fine. That's not the issue. But it's important that you at least have a base level set of rules trying to cover as many potential scenarios as possible before you actually do any trading. So, as I said, step one, eliminate subjectivity, and you do that by having your rules or your rule set in place. But there's absolutely no point in having a set of rules if you don't know whether or not they actually work. A lot of the time, what people do is they develop a set of rules which theoretically, make absolute sense, but when applied to a particular market or a live market environment, they just don't perform. So the next step is eliminating that uncertainty in terms of the performance of your rule set. And the way we need to do that is by testing. So in this particular example, again, on this intraday system, I just want to show you an example of how we've tested it, or a sample of our testing actually. What we've done is we've taken a year's worth of charting data, and I actually do this manually. There's different ways you can code it, but what I find is that when you're manually going through a chart, it really just helps to build up that confidence in terms of the fact that this particular rule set is producing positive results. When things are done automatically, you press a button and it churns out a particular set of results. That's all very well and good, but sometimes it doesn't give you that feel for really getting your hands into the chart and making sure that what you're producing actually has some good, tangible, positive outcomes. So all we have here on the chart is simply all the trades for that particular rule set. What are all the trades? And we ran this for the period from 30 March 2015 to 30th of March 2016. So each individual trade, it's a 15-minute Aussie trading system. So we did each individual trade that came across our radar across that year, and you'll actually see there's there are 150 trades, and then we record each piece of data, as many pieces of data as we like, or for the trade. So when did we enter the trade? We get into the time we entered the trade as well. It's a 15-minute time frame. Was it a long or a short? What is our entry level? What is our stop level? What is our target? What is our planned reward to risk? If that's part of your rule set says that you need a minimum reward to risk level in order to enter the trade, you need to calculate what your anticipated reward to risk ratio is. Where did we exit the trade? When did we exit the trade? What was the outcome? How many points did we make, or how many points did we lose? And we simply go through that process by looking at our charts and recording each individual trade as we go along. So what that does is, by testing in that way, it eliminates uncertainty. It says we have a particular rule set and we've tested this particular rule set. So we know, based on our large sample of trades, what the potential outcomes are. Now let's just talk a bit about this concept of sample. In this particular example, I've taken a year's worth of trades on 15-minute charts. What I would suggest is, this is the minimum that one needs to take if you're developing a rule-based trading system like this. So if you've got an intraday system working on 15-minute charts, do a year's worth of testing at least. The problem with that is, what if it was a particular year where the trading system worked and it doesn't work in any other year? What I would then do is complement this particular year's worth of sample data with a random sample. Maybe take another 150 trades, but randomly select them from different time periods over the last 5-10 years, whatever the case may be. The point is that the bigger your sample, the more certain you are that the results being produced by that sample are a true reflection of what the system's rules produce. So, by doing our testing, we then eliminate uncertainty. The next thing is we start playing around. This is the concept of decoupling our results from our expectancy. So let's look at the results of this particular sample that we've backtested over here. We had 150 trades, 65 were winners, 85 were losers. On average, the winners produced 2.59 units of profit, and the losers produced 1.14 units of loss. So our average reward to risk ratio across that sample is 2.28 to 1. Our win rate, because we had 65 winners and 85 losers, is 43%. And so we can calculate what our expectancy is. So let's talk a bit about that. Simply put, our expectancy is an indication of what we expect each individual trade to produce in relation to our units of risk. So in this case, because we have a 43% win rate, 43% of the time we expect to win 2.28 to 1. 57% of the time we expect to lose 1 unit of risk, creating an expectancy of 0.48 units of risk per trade. What is a unit of risk? Well, a unit of risk is really, and this is where the concept of money management actually starts coming in. A unit of risk is, simply put, what you are prepared to risk on a particular trade. I'm not going to get into money management. We'll deal with that in a separate video. But simply put, if you are willing to risk, for example, in this particular example, 1,000 Rand per trade, our expectancy is 0.48 of that 1,000. So our expectancy is 479 Rand. We expect to win 479 Rand every time we risk 1,000 Rand. Every single time. And the most important aspect of all of this is that we have a positive expectancy at the end of the day. The win rate is, in a sense, irrelevant. 43% win rate means that we're actually we're losing 57, we're losing more often than not in terms of this particular system. But when we do win, we win 2.28 times more than we lose, creating this positive expectancy. So you can then start, doing scenario analysis and saying, okay, if I risk 5,000 Rand per trade, what is my expectancy? It's 2,395 Rand. But as I said, the most important aspect of this particular set of results is really that expectancy number. The other important thing is, remember, we've tested this over a year period. We've gotten 150 trades. So what does that mean? On average, 150 divided by 12 months. We're doing 12.5 trades per month. So now we know a bit more about the system. We know that it has an expectancy of 4.48 units of risk, and we know on average we're doing 12.5 trades per month. That's quite important if we need to build this particular trading strategy into our overall we'll call it this particular system into our overall trading strategy. The other important thing to look at is our equity curve. So this is the equity curve based on this backtesting result. So let's have a look at it. See, it's a nice positive equity curve, had a good outcome. Scenario analysis, let's play around with a couple of things. You'll see round about trade 17 and round about trade 130. We have these huge spikes. Those are big positive trades. Now those kinds of things are great to have, but if your trade expectancy is dependent on having these big spikes, I would suggest you revisit some of your trading rules and testing again. So from a scenario analysis point of view, for example, take out the outliers, take out these huge trades. They come great, and they really boost your system's results and performance, but your system should not depend on, or the profitability of your system should not depend on a handful of individual trades. So eliminate that from your results, and then look at your equity curve again. In this case, even if I eliminated that particular one and that particular one, we'd still have a nice positive equity curve and a nice positive expectancy. Look at things like your maximum drawdown. If you look at from this, let's use this one, trade number 75 all the way through to trade number 130. So that's 55 trades. We don't make any new equity highs. Now that's a long period for a drawdown to take place. Remember, we're doing about 12 and a half trades per month. So that's effectively 4 months worth of drawdown over there. 4 months of not making any fresh equity highs. Again, you need to understand that, know that that is a possibility, and then make an assessment of whether or not that is acceptable in terms of your own overall trading strategy. And you know, the things that that could impact on is if you are relying on your trading system to produce consistent profitability, you know, you need to have enough of a capital buffer to be able to absorb that kind of a drawdown. Psychologically, it can have a massive impact not to be making new equity highs over a 4-month period, but you need to be able to deal with that, or at least understand that that is a possibility, so that when in reality it happens, it isn't as much of a shock to the system. If you have a bad week, or you're not making equity highs for 2 or 3 weeks, or you get 5 or 6 trades in a row that are losers, you don't become despondent, because you know within the bigger context, within the bigger picture, you are still trading the system with positive expectancy. So there's a host of different ways you can use these results from the backtesting to really analyze in depth and do scenario analysis around your trading outcomes. And so that decoupling of results and expectancy using the scenario analysis that I spoke about is a really important aspect of gaining trust in your system. And then the last aspect that I want to address is executing with confidence. Obviously, this set of data over here is theoretical. So in other words, I've put in the theoretically perfect entries, stops and targets and exits, assuming that based on the trading rules, that is the number that we've gotten in at and out at. There's going to be errors, there's going to be slippage, missed trades, whatever the case may be. That is simply human nature. So again, when you do your scenario analysis, you know, put in a discount factor and say, you know, I assume I'm going to have a 5 or 10% deviation from actual results because of you know, these kinds of errors or slippage or whatever the case may be. That is the reality of trading. I'll give you an example. This is our last 80 trades, not necessarily using that particular system, but what you'll see here is the red line is the theoretically perfect trades according to systems rules, and the blue line is the actual trading outcomes. So when you are trading, and as I say here, execute with confidence, elimination of error, your focus is not on the shape of these lines. Instead, it's on this gap between the theoretical and the actual, and making sure that you eliminate or at least reduce the size of this gap as much as possible. That's all. Because when you're trading, when you're in the live trading, it's about elimination of error. It's not about expectancy. Expectancy is determined before you get into the live market. Expectancy is dealt with when you are backtesting your system and becoming comfortable with it. When you're in the live market, it's about eliminating error and executing your trades as closely as possible to your system's rules. So just to recap, if you want to develop trust in your system, the first thing you got to do is you got to have rules and eliminate subjectivity. You have to eliminate uncertainty by testing those rules over as large a sample as possible over different market environments. Also remember that a particular trade may work in a particular market on a particular time frame, but not in another market or not on a higher time frame, unless you can actually test in those different conditions. or with those different variables. Then you do your scenario analysis and make sure that the outcomes are favorable. You have a positive expectancy, and you can deal with the drawdowns associated with your rule set. So decouple that results. The individual trade result is irrelevant. Focus on the expectancy. And lastly, in the live environment, it's about executing with confidence and eliminating error. That is going to be your focus. Guys, that's it for today. Hopefully that was useful. Drop me a line. That's richard@underdoginvestments.co.za, or leave a comment under this video just to give me some feedback in terms of how you experienced the video. That's it for today. Cheers.